In this video today, I'm going to be sharing with you one of the most misunderstood financial tools. A year ago, I got into the financial services industry and I started to learn about different products and services. And when I would get online, I would hear so many hate comments and so many negative comments about this one particular tool. And I decided that, look, if I'm going to be in this industry and I'm going to provide this specific product and I don't really understand the ins and outs of it, I'm going to invest in myself. So the information that I'm going to be sharing with you inside of this podcast episode today, I have invested $6,000 to learn this information, and I'm sharing it with you so that you can make sure that you understand what you will possibly be purchasing, and you will know if someone is trying to scam you, and you will also be able to ask qualifying questions to know if the person that you are working with has integrity or not. Now, this particular financial tool that I'm referring to is called life insurance, and specifically, it is an indexed universal life insurance policy. Now, being in this industry, there are a few things that I've noticed. The first thing is that there are many people out there who are only looking to earn commissions. They don't care about the person. They don't care about what goes on with them after they sell them a policy. All they care about is, did I sell somebody a policy? And when the renewals come up, I'm going to touch base with them. I didn't like that. And I said that I was not going to be that type of person. The next thing that I noticed is that many of these people that are selling specific products, they do not understand the ins and outs. Like, when it comes to these specific products, I personally believe, especially in the financial services industry, but really within any industry, you should be an expert. Okay, you should be able to answer questions. And especially in these days with AI, like, there is no excuse for you not to be able to answer questions and really understand the ins and outs of what it is that you are providing for people. Now, before we get far off into it, many people believe that there are 3 different types of life insurance. I personally do not agree with that. There are different types of insurance products, but there's only 2 types of life insurance. The first one is the type of life insurance that you rent. Okay, you do not own this life insurance. This is basically to just cover cost, and this is something that you can get a large amount for, but you don't really get a lot in return, and this is called term life insurance. Now, when we go over to the next type of life insurance, we have permanent life insurance. This is life insurance that you can potentially end up owning, basically because you end up having built up what's called cash accumulation or cash value inside of this policy. So the first thing is, you need to make sure that you understand that there are 2 different types of life insurance. There's a temporary life insurance, which is a term policy, and we have a permanent life insurance policy, which can be many different things, final expense, guaranteed universal life, whole life, index universal life, variable life. That can be a lot of different options when it comes to permanent life insurance. Now, the next thing that we need to understand is the terminology, because when you start to get into these financial sectors, many people use all this lingo, and personally, I believe that they don't even understand what they're talking about. I personally believe that they're using this lingo to try to make it seem like they are smarter and that they understand what they are doing when they really don't. All they're doing is regurgitating something that someone else has actually said, and they already know that most of the time people don't want to feel dumb and they're not going to ask the questions. So they just say these big names that make people feel bad, and people end up tuning out. So the first term that we're going to focus on is called the death benefit. What exactly is the death benefit? The death benefit is what the insurance company promises to pay out as long as your policy is intact, and they will pay this out to the person that you have listed, which is your beneficiary. And your beneficiary is basically someone or an entity. Notice I said entity. So that doesn't mean it could be a trust. It can be a specific person that you have designated that, okay, when I pass away, I want these proceeds to go to this specific person or this specific entity. Now, the way that I want you to look at this is, let's say that you have $1 million policy and you end up passing away. Let's say that you're married or you have children and you decide that you want to give the money to them or you want them to be your beneficiary. Well, that $1 million will go to them unless they are under the age of 18. Then it will not go to them. It will basically go and be in a type of an account until they become 18 years old. And the reason why this matters is because the death benefit is not just some random number. Many people think that, oh, they toss out $500,000 or $1 million in death benefit. But here's what the death benefit will actually affect. Number one, the amount of protection that is being provided. Obviously, there's a difference between a $500,000 policy and $1 million policy, which is based on the payout. The next thing you have to worry about with the death benefit is the insurance charges. Okay, there are insurance charges with life insurance, just like there is with any other financial product. Next, we need to know how much premium can the policy accept. And this is going to be very important later on, getting into the index universal life insurance and how it works. Then we need to know the relationship between the insurance protection and the cash value. Okay, if you have a permanent policy, we need to understand what is the relationship between the insurance protection and the cash value. Now we also need to understand, finally, how is the life insurance policy structured to be able to comply with the insurance or the life insurance tax rules. So the next thing that we're going to talk about is, what is the cash value? As I just mentioned, cash value. So this is basically money that can accumulate inside of your permanent life insurance policy if you have a variable life, if you have an index universal life, or if you have a guaranteed life or a whole life. Basically, what happens is it develops different amounts of terms, charges, guarantees, and crediting mechanics that allow for you to be able to have potential gains on the money depending on what type of policy you have. So the easy way to think about it is the death benefit is something that is set in stone. Most of the time when you end up purchasing your policy based on the death benefit, that is what your insurance policy is going to refer to every single year because of something called annual renewable term. Now, with your annual renewable term, this determines, okay, you are this age, you are this gender, and here's your health status. So once you end up getting your life insurance policy, your policy charges will increase a bit because it is based off of your age, okay, and your gender. Your age is going to change every year. So this is what is called annual renewable term, which means every year it'll get a little bit more expensive. Now, depending on how your policy is structured, it could potentially get cheaper as time goes on. But this is what will affect your cash value. So the death benefit, as we talked about earlier, is the primary protection if you die, or really when you die. The cash value is the value inside of the permanent policy that allows for you to access money that has accumulated as you are living. Okay, this is why you may hear a lot of this called living benefits. And many people don't explain that. So when you have cash value building up inside of your life insurance policy, there are ways that you can access that cash, and you can access it while you are alive. And there's different, financial obligations that you may have that will allow for you to be able to access it. Now, how will your cash value be accessed? Well, there are 3 different ways. There's a smart way, there's a dumb way, and there's the sad way. So the sad way is the way that you end up accessing your policy is when you pass away. And obviously you're not accessing your policy money because it's passing on to your heirs or your beneficiary. Now, the second way is taking out withdrawals. That is the dumb way. The reason why it's dumb, which we'll get into later, but the reason why it's dumb is because it will cause for you not to be able to have some of the tax advantages that an index universal life allows for you to have. The second or the third way is you are able to have what's called policy loans. And we'll get more into that because I know many people, they hear loans, and even I heard loans, and we automatically think about a negative thing because we don't want more debt. But in this situation, the debt can end up being good. Now, it's very important that you understand that just because you have cash value inside of your policy, it doesn't mean that you can just go and remove every single dollar out of your policy. This is going to affect your policy when you go withdraw it, which is what I was sharing with you earlier of withdrawing your money. Now, when you have withdrawals and when you have loans, here are some of the things that it can affect. Number one, the policy value. Number two, the death benefit. Number three, the future performance, because the performance is based on how much cash value you have in there. Number four, the policy sustainability, which basically means how long is this policy going to be able to last. And number five, taxes, depending on what policy you have and how it is structured. Now we have the surrendered cash value. The surrender cash value is basically saying that within this particular time frame, if you surrender your policy, which basically you end your policy, this is how much you will be able to get back. And these are the charges that you are going to end up paying. And you have to know what that is. And if many people are not telling you that, which I have noticed that so many life insurance agents will just breeze over this like it's something that's not a big deal. And it is a big deal. And many people that are putting certain individuals into these policies and they don't understand them, this is how these policies can end up being more or doing more harm than they are good. So now moving down, what is a premium? Okay, a premium is the money that is paid into the insurance contract. Now, I want you to understand that there is a difference between the premium that someone pays and the cost of insurance. And I'll talk about the cost of insurance next. But the premium, let's say that you end up sending $1,000 a month towards your policy. Well, your premium is $1,000. But where people get confused is they think that they're paying $1,000 for life insurance. And technically, you are not paying $1,000 for life insurance. You are inputting $1,000 as a premium. The cost of insurance is how much does it cost for you to have insurance. Now, earlier when I talked about having a $1 million death benefit, the $1 million death benefit at your specific age is going to cost a certain amount of money. And when you are paying that money, that is what allows for you to have this contract with the insurance company. Now, when you end up having like a permanent type of life insurance policy, like a whole life or an index universal life, when you're putting premiums in of $1,000, let's say that your cost of insurance for your age is $70 a month. Well, you are paying $70 for the $1 million worth of insurance, but the other part of that money is going towards what's called cash value, as we stated earlier. And this is how you are able to start accumulating interest. This is how you are able to start, having opportunities to participate or even have some of the market gains and have your account grow over time, or the money in your account grow over time, or in your contract grow over time. So now we need to understand, why does the cost of insurance matter, which I stated this a little bit earlier, and that is it is going to be affected by three main things. Number one, your age. There is something called a mortality chart, which is come up by these scientists and genius and all this stuff. But what they do is they basically try to predict that based on your age, based on the next one, which is your gender, and based on your health status, here is about the length of time that you will be alive. And then they based the cost of insurance on that specific thing. So if you're 31 and they take 1,000 people, what is the average rate of 1,000 people with this specific type of health product, this specific type of health, this specific type of age, and this gender? How are they going to end up living? Okay, how long are they going to end up living on average? And that's what they end up doing. So now what we have to start doing, which is the part that I really enjoy, is understanding what exactly is index universal life, or also known as IUL, or also known as the rich man's Roth. IUL is basically a permanent life insurance policy that provides a death benefit, and this death benefit has the ability to build up cash value with interest crediting strategies that are linked to performance of indexes, which are like the S&P 500 and the NASDAQ 100. So the S&P 500 and the NASDAQ 100. Now, generally, when it comes to an IUL, what are the things that are included? Number one, life insurance protection. Okay, you have a death benefit. That's the first thing. Without that, this is not a life insurance policy. The next thing is cash value. Okay, then you have policy expenses. You have cost of insurance. One of the things that many people don't understand and they actually really like is that, or that I really like, is that you have flexible premium features. And what that means is, let's say that you decide, hey, look, I want to put $500 a month into my policy. And I've actually done this before. I want to put $500 into my policy. And when I put $500 in, that's going to be on a consistent basis. Now, my insurance may only be $100 a month. So that extra $400 is going towards the cash value, which means it has the ability to possibly gain some interest and grow. Now, let's say that a hardship ends up coming and I say, hey, look, I can't really keep putting $500 into this policy. I'm only going to put $100. Well, you have the opportunity to be able to do that. And this is why I realized that there are some people that really like this. And this is why I really like it, as I stated before, because you have the option of having flexible premiums. Then we also have the interest crediting option. Here's what I want you to know, that the policy owner is generally not directly investing into the stock market or purchasing shares of the index. Now, the reason why I want to say this is because there are many agents out here who are selling life insurance policies as an investment. It has an investment component, but it is not an investment. It is a life insurance policy. And as we get more into this, you're going to understand why you want it to be a life insurance policy, a life insurance contract. And I already know, I've got on these people's lives when they're on TikTok and on Instagram, and they've talked about, well, I really don't, this life insurance policy, you can't use it for this and you can't do it for that. And it's not for retirement income. And it's not for this. But let me ask you this question. When I was younger, my grandma used to always have something in the house, and it was in an orange box. And on the box, it said baking soda. Now, for just about 10 seconds, I want you to think about 2 to 3 things that baking soda was used for. Okay? Ready? All right, go. Okay, now that you have thought about the 3 things that baking soda is used for, some of you that are listening to this, you may have said, well, baking soda is used for, upset stomach, or maybe it's used to brush your teeth, or maybe it's used for being able to help unclog drains. Well, many people forget that baking soda can also be utilized for baking. And the reason why I bring that up is because so many people focus on what the product is and they don't focus on what it does. Like, if you think about it with baking soda, if you had an upset stomach, or at least I know that I've done this before, if you have an upset stomach or you feel bloated or something like that, you get a little bit of warm water, put maybe like a tablespoon of baking soda in it, and you drink it, and now that ends up helping your stomach. Well, this is kind of the same thing with a life insurance policy. Yes, it is a life insurance policy. However, there are many different factors, and there are also many different benefits that having one of these types of contracts allows for you to have when and only when you understand how those things can be utilized. So this is the part of me that I get frustrated, because when I get on there, they're saying part of the truth, but not the whole truth. And then they go and they're confusing people. And one of the things that I've noticed is that, and this doesn't matter if you're selling life insurance or people selling life insurance, they're selling 401ks, IRAs, they're selling mutual funds, whatever. I've realized that people always talk about educating. They always talk about educating, but they only educate people enough to move in one direction. And it's like they're trying to sway them or sway you to think about this in a specific way. Now, personally, for me, I believe that everyone in here is smart enough, or everyone that's listening to this is smart enough to make the best decision for themselves. Even if that means deciding to say no, or even if that means deciding not to make a decision, which I see as as being no. And what my job is, at least what I believe that my duty is as a financial person that's in the financial services space, it is not my goal to persuade you, or it's not my goal to convince you to do something that is in your harm or that's going to do harm to you. It is my job to let you know and educate you about what it is that this product can potentially do and how it can potentially help you with your goals. Whether you decide to do it or not, that should not be my factor of, well, this person didn't do it and I don't want to talk to them anymore, and all this other stuff that people do. They just have these little temper tantrums. My goal is to make sure that people are 100% educated, and that's even part of the reason why I'm making this video. And I want to make sure that you are making the best decision for yourself, because if you end up having questions, guess what? You can raise your hand and ask more questions. And if people would go about it this way, I personally believe that there would be more success within this financial services space, and not just somebody selling you a product just so they can make money to provide for their family, which I'm not mad. Yeah, like, you want to go make money, you want to go provide for your family, that's cool. Go do that. But what I don't like is when you do it at the expense of someone else's ignorance, because that's not cool. Now, why does the policy design matter? The reason why the policy design matter, most people say I own an IUL, but they don't understand that when you have an index universal life insurance, it can be designed many different ways for many different reasons, for many different outcomes, depending on what the person's objective is. Now, number one, greater death benefit emphasis. This is one design, okay? Basically what happens is someone has a larger amount of insurance and their policy basically has a larger death benefit than the amount that's incongruent with how much premium they are putting in. So when it comes to an index universal life insurance policy, obviously, let's say you get $1 million. Well, if you end up getting $1 million policy, you're going to be paying for $1 million worth of cost based on your age, your health, and your gender, and what it costs to have $1 million of a permanent policy. Number two is it has a cash accumulation emphasis. This is the design number two. So if someone wanted to place more emphasis, or maybe they wanted to store up more cash, what they would do is they will have a design that's focused on long-term cash accumulation. So this is going to be designed with a difference between the premium and the death benefit, while still being able to satisfy the tax requirements determined by the IRS. Now, people would say that, well, I have this properly structured, and they don't even know what that means, because you can have it structured to do one thing that is not in the best interest of the client that you have. And when you are looking for a cash accumulation policy, here are some of the things you have to think about. Number one, you have to think about the death benefit option, which there's an increasing and a level. You have the premium amount. You have the premium timing. Are you paying every month, every quarter, every year? Then you have the policy charges, because it does have charges. You need to know about the carrier, which is basically the insurance company that is going to provide you with the insurance and the contract. You also need to know about crediting, the performance, the withdrawals, the loans, the policy management, all of that stuff. So you cannot just properly evaluate an IUL by simply knowing that somebody owns one. The question that I always ask is, okay, well, what was the reason why you got this? And I even start asking, well, what did they tell you when they sold you this? Because a lot of people will just say anything to get someone to buy, and that's not right at all. So then now, here's something that's really big, and many people don't think about this. Usually, anytime I think about the government getting involved in something, there has to be a sweet deal for the government. There has to be a sweet deal for the IRS. And you may be sitting here thinking right now, like, Matthew, what are you talking about? A sweet deal for the IRS, a sweet deal for the government. Well, as I started to learn more about this from my coach that I paid $6,000 to learn this from, I did not realize that there were internal revenue codes for life insurance. Now, you might be sitting there thinking like, Matthew, well, what are you talking about? There are codes that are out there that tell you how much you have to pay in taxes, that tell you what you can't do, that tell you what different financial tools and different financial vehicles are able to do and what they're not able to do. And basically, this is a guide, a rule book, and a guide to help people with understanding these different financial tools. So when it comes to index universal life insurance and really just life insurance, period, that really made me like, so there are rules to this. Why are there rules? And what I discovered is that back in the day, when you had people like John D. Rockefeller, you had people like Henry Ford, you had people like the Vanderbilt family. These people were taking their money and putting it inside of a life insurance policy, and they basically were paying no taxes on their money. So all of their money was basically tax-free because they put it inside of this life insurance policy. And what you have to understand, if you really want to be able to get the benefits of this, are these 5 things. Number 1, what are the rules? You have to understand the rules of the game, and you have to play the game by the rules. Number 2, what qualifies a contract as a life insurance contract? Number 3, how much premium can be contributed? Number 4, how much death benefit has to remain? Number 5, what happens if the policy is funded too aggressively? Now, this is where people get in trouble, because the fact that this appears in the tax code does not mean that this is a good investment. Life insurance is not an investment. And I'm going to keep saying that over and over again. Life insurance is not an investment. However, it's important to understand that there are specific federal rules governing the tax treatment and qualifications of life insurance contracts. So you already know, you might be asking, well, Matthew, what exactly are these codes? I'm glad you asked. We have the first code, which is IRC section 7702. Okay. IRC stands for Internal Revenue Code, and it's section 7702. This basically says if a life insurance contract is a life insurance contract, if it qualifies as a life insurance contract based on the federal tax purposes. Now, I'm not going to get into the weeds of things, but there's basically 2 different types of tests that determine if it qualifies as a life insurance policy. And what you just need to know is that there is a relationship between the premiums, the cash value, and the insurance protection. So IRC 7702 says if you are putting in this amount of premiums, which, remember, premiums we talked about is the amount of money you're putting into an insurance policy. It is not necessarily the cost of insurance. Those are 2 different things. So if you are putting, let's say, $1,000 inside of your life insurance policy, There's only a certain amount of cash value that you can have. And based on that, you have to have a certain amount of life insurance. That's basically what it is. So then we have what's called a modified endowment contract. Now, the modified endowment contract is when the life insurance policy under federal law fails what's called the 7-pay test, which basically means in a span of 7 to 11 years, there is only so much money that you can put inside of a life insurance policy, depending on how much you are putting in, what the death benefit is. And that is when people really start messing up, because they don't understand that this life insurance policy is still a life insurance policy. However, what you have to realize is that the tax treatment and the distributions have changed. So the life insurance never ever stops being a life insurance contract. However, what it does say is that if you put in more money too fast and you have a modified endowment contract, what's going to happen is this is now going to be taxed as if it were an investment, but it's still a life insurance policy. The tax or the death benefit is still going to be income tax free to your beneficiary, and you will still be able to put money into it. However, when it comes to the policy loans, when it comes to withdrawing, which I don't believe anybody should ever withdraw, that's what's going to end up being different. And you have to really understand, and this is why it's important for somebody to really understand what it is that they're doing, because you can put somebody in a worse position than they were in when they first, or even without having the life insurance contract. Now, the reason why indexed universal life insurance is not the same as investing in an index is because the policy uses the S&P 500 or the NASDAQ as a reference to then potentially give you credits on your policy where you have that cash value built up. Now, when it comes to this, some of the things that you need to understand, which this is just a general overview, you need to be able to understand that there are what are called caps, which means that there's only a certain amount that you can earn. And the reason why is because when you have money inside of a life insurance contract, you will never lose your principal. And every year your principal locks in and it resets. So let's say that you put in $1,000 a month at the end of the year. You got $12,000. Let's say that you were credited 10%, which basically was $1,200. Now you have $13,500 or $13,200, and that is your new principal. You will never lose your principal. And this is why this is so important. The next thing we need to understand are like participation rates, spreads. Like I just told you about the floors. We need to understand the crediting periods. Is it monthly? Is it quarterly? Is it yearly? And we also need to understand the strategies over the specific terms. Okay. This is why it's so important for somebody that knows what they're doing to get inside of this. And this is why I just didn't want to go out and just be selling stuff. I wanted to understand what it is that what I'm doing. And let's say that you end up doing well and you end up having the index move up 12%, but the cap says it's 8%. Well, you're only going to be able to earn the 8%. And that's the reason why the cap is there, is because you're not going to lose any of your principal. Now, when it comes to your policy loans, basically what ends up happening is you are able to access your money tax-free via policy loans. And the reason why this is so important is because when you really understand how money works, which many wealthy people do, you will see that, hey, look, I'm protecting my money that I worked hard for, and I'm putting some of this inside of this contract, and I'm going to borrow against it, which means you're using your funds as collateral. And when you use your funds as collateral, guess what? It's like you never touched it, and you can still be able to have a lot of growth. This is very important because many people will say that, oh, well, you're borrowing your own money. No, you're not. You're not borrowing your own money. What you are doing is you're using your money as collateral in the insurance company, which is the backbone of America, the backbone of the world. They have different portfolios and different things that they do. And what they will say is, okay, look, we have your money inside of here, or you have your money inside of here with us. And instead of you taking that money out, what if we give you a loan of a certain amount against how much you have? So if you have, let's say, $100,000 within this policy, then maybe you're able to get a loan up to like 50% of that, or maybe even 80%. It just all depends on what company you're with and what your terms are with that specific company. And the reason why you would want to take a loan is because inside of the Internal Revenue Code, there are only 3 types of income that are taxed: earned income, portfolio income, and passive income. When you are getting a loan, that is not deemed as income, so you don't have to pay taxes on it. And this is why this becomes so powerful. Now, the reason why people will borrow against a life insurance policy is for many different reasons. Maybe they wanted to buy a car. Maybe they wanted to send their kids to college. Maybe they wanted to pay off their house. Maybe they wanted to get out of debt. There are many different reasons for borrowing against your policy. Even taking out retirement income that's consistent, you can do that because it's for any type of financial goal that you have. Now, what we have to be able to understand is that when you do borrow money, what do you still have? You have an interest rate. Now, the great thing about still leaving your money inside of your contract and borrowing against it is, let's say that the insurance company charges you 5%, but with your money inside of this particular policy contract, you are able to earn 8%. Well, you are basically getting paid to allow or to borrow against your own money. You take the 8% minus it by 5, you have now a net of 3%, and that's what's going to allow for you to be able to still have some market gains potentially, or some gains potentially, not market gains, potentially have gains. And the reason why the IULs can look so different is just because people don't know what they're doing. Some people will have a high death benefit. Some people will have, too much cash value, cause for it to not be able to perform in a way that they told the client. People are trying to sell this as an investment when it's not an investment, it's a life insurance contract. And part of the reason why you don't want it to be an investment is because of the death benefit. When you have the death benefit, which many affluent people utilize this, when it gets to a certain point, their life insurance policy will pay for itself based on the interest. Now, when it comes to having your cash build up inside of this particular policy, you are not able to utilize the cash that's in there to pay for your fees. Now, you will still have like a management fee, but a lot of your fees will end up going away, which allows for your policy to potentially become even lower as far as your fees when it comes to your health and when it comes to your age. Now, many people will say that, oh, I'm going to just wait and I'm going to just do this. But here's what you need to know. The younger that you are, the cheaper your life insurance is going to be. However, when it comes to index universal life insurance, the older that you are, you could also potentially be paying the same as much in insurance as someone that is much younger than you. And the reason for that is all because of how it is designed. And here are some questions that I want you to know about. And the questions that I want you to know about, and actually before I go to these questions, because these are going to be questions that I want you to ask your agent or potential agent that's prospecting you or whatever, that's trying to get your business. You need to understand IRC section 7702. You need to understand 72E, IRC 72E, which allows for your money to grow tax deferred. And then you also need to understand 101A, which allows for the death benefit to be tax free. These are the three things that you need to know and you need to understand. So now when it comes to questions that you need to ask your financial person or financial agent, life insurance agent that's trying to sell you a policy, what is it that you need to ask them to know if they really know what they're talking about? Number one, what is the problem that you are trying to solve? Okay. And it's not necessarily the agent. This is more so for yourself. This question is for you. What are you trying to solve? Are you trying to save for your kids' college or your children's college? Are you trying to, save up for a house? What is it that you are wanting to do? Then when you decide what you want to do, now you need to know, okay, how is this policy being designed? Now that you know how the policy is being designed, now we need to understand, okay, what is the cost of insurance and what are the premiums that I'm going to be putting inside of this policy? Next, we need to know, okay, what are the rules? Do I have tax advantages? If so, is it going to be tax free? How do I make sure that I don't break the rules? Then we need to know, okay, what are the risks? Next, we need to know how liquid is the money. Because if they don't structure it right, guess what? You're not going to have no liquidity. And really one of the biggest points of having an index universal life insurance policy is consisted of four things. Number one, you want liquidity. You want to be able to have access to your money when something is happening and large amounts of it. The next thing is you want to make sure that it's safe. You want to make sure that you're not losing money due to market losses, market crashes, market volatility. The next thing is, number three, you want to make sure that you have tax advantages, okay? When you have tax advantages and even possibly tax free, now you're going to be able to really see some potential growth because your money is going to be working for you, and it really could be working for you 2 or 3 or 4 times, depending on how many times you're borrowing against your policy and for what. And the last one is you want to have a consistent rate of return. And that's very important, especially in this day and age, in this economy, because when you have a predictable rate of return, you can start using what is called the rule of 72, which allows for you to know how long is it going to take for your money to double. Now, what has learning about IUL helped me understand? Number one is help me understand how money works and even how the banks utilize money. So it helps me understand cash flow. It helped me understand the risk, the taxes, how to leverage debt properly. It taught me about liquidity. It taught me about what insurance actually is, compound growth, the opportunity cost, how to design the product. And when it comes to wanting to build wealth, you always have to think about the long-term plan. Because if you are reacting to what is going on in the market, you are going to end up being in trouble because of the fact that you are trying to guess the market and nobody can. But if you're playing the long game and you focus on being consistent with what you can do, this is give you the ability to potentially have more success. I think one of the biggest lessons is that you need to be able to understand what financial tools you are utilizing. What is it designed to do before you decide on where you're going to put your money. The reason why this is so important is I've stated it earlier, and I'm going to continue to say this, is people need to be properly educated so that they can make the best decision for themselves. They know what's good for them. They know what's not. Because the last thing that you want to do is somebody to do is try to convince you to do something that you don't, or persuade you, convince you to do something that you don't want to do. Because when you do that, guess what? Now they're going to resent you for it because they didn't make the decision themselves. So now when you hear IUL is bad, you will be able to know that you need to ask better questions. Instead of asking if an IUL is good or bad, what you want to do is you want to ask yourself, how was this IUL designed to work? What is the particular policy designed to accomplish? What are the costs, the risks, the benefits, and the limitations based on this particular design? And does this actually fit the person's goals? Because if it doesn't, it's not that the product is bad, but it's that the person that designed it is not that good of a person. Now, when I think about this, I'm not telling you to go out there and get an IUL. I'm not telling you to go out there and say that, oh, the IUL is the best thing ever, or even it's the worst thing ever. What I would like for you to understand is that an IUL is a financial tool. And just like a hammer, just like a screwdriver, just like a saw, just like a drill, when you understand the purpose of the specific tool and you use it correctly, you are able to get the maximum benefits from it. So I hope that this was helpful, and I will catch you in the next video.